Now, like most anything, there is a right way and wrong way to go about oil and gas investing. Let's talk about the wrong way first. In fact, if you've ever heard someone say oil and gas investing is too big a risk, or I've lost money in oil and gas investing, you'll see here exactly how that happened. The traditional way of doing it, the investor sinks $100,000 or more into a single well investment. Since industry-wide, only about half the wells drilled are producers, just imagine you write a check for $100,000 or more, and then dig in your pocket and flip a coin to see if you just lost your money. That's not too great a proposition, is it? Of the producing wells, roughly half are marginal. Generally, about 1 of 10 wells drilled could be called outstanding. The investor's chances of losing their entire investment is over 50%, and the investor's chance of hitting the big time is less than 5%. Pretty easy to see how the old way of doing it has left a poor taste in some people's mouth. Let me share with you the proven right way. Now, this example is based on a 50% completion rate, even though our company has a proven track record of 60 to 80% completion rates. We have here a 20 well investment bundle. You'll note that on the first well we hit and we're producing 5% per month. That's pretty exciting. We drill 2 more wells and both are dry holes. Now, in the old way, how would a person start feeling? Anyway, we're spreading our investment over 20 wells, so let's continue. Here's a couple hits, another hit, 3 dry holes, another hit, 2 more dry holes. There's a 6% per month, a 2.5, and then another flop. 12% per month. There's that big time well. Then a dry hole, 3.5%, and finally yet another dry hole. Okay, so what happens when you spread your investment like this? At only a 50% completion rate, the average rate of return per month, 2.4%. That amounts to 28.8%. Not too shabby. But look at this. After you take into account at a 33% tax bracket, that's probably what Uncle Sam's hitting you up for, right? At least until it gets higher. Well, that equates to 14.2% tax refund. Altogether, tax impact included, your net on these 20 wells at a 50% completion rate, 43%. If these results were possible for you, you would want to take advantage of it, wouldn't you? Let's talk a little bit about managing the risk. We had a statistician do a study on approximately 60 wells we invested in during 2003 and 2004. The results are where we got the formula of working with a minimum of 20 wells. Likelihood of loss of investment decreases as the number of wells increases. Spreading the investment over a sufficient number of wells statistically reduces the possibility of losing all of your investment to a negligible amount. You see, if you only invest in one well, you have over a 50% chance of losing your entire investment. But as we increase the number of wells you're invested in, the risk keeps decreasing. Around 20 wells, the risk becomes negligible. Make sense? Okay, about now, some people are wondering, how does this compare to buying gold? Gold requires a once every 25-year economic catastrophe versus black gold, which is a long-term profitable enterprise. You are a partner in an actual business. With regular gold, there are no monthly checks. With black gold is a steady cash-generating source of income. Hoarding gold requires currency devaluation, which is inflation. Now think about this. With your gold, the only reason your value goes up isn't because the gold is actually worth more. It's because the money, the paper money, is worth less. With black gold, global demand increases reserve value. With gold, neither moth nor rust doth corrupt. In other words, a lump of coal isn't going anywhere once it's been dug out of the ground. With crude oil, it's a consumed, finite resource. Crude oil is used up, thus generating even more demand. The price of gold is now at a speculatively driven all-time high. With crude oil, there is a current opportunity to buy low. With gold, all realized profits are taxed as capital gains. Now picture this. Remember where the value of gold comes from? It comes from the value of money going down. So you end up paying capital gains tax because your money is worth less. That's just nuts. With black gold, there are 200% tax deductions available. Gold ownership was outlawed in 1933 and could be outlawed again at any time. Uncle Sam encourages domestic production through tax incentives. After economic recovery, production of gold will easily keep up with demand, and that will result in falling prices. With black gold, after recovery, demand will inevitably accelerate and outstrip new discovery, which equals rising prices. Gold is purely speculative, where black gold is a business endeavor with control over risk and reward. You must pay for storage of gold, or have extra security to store it at home. The earth stores your black gold for you at no extra charge. Cash out with gold requires an expensive broker, margin, or a barter. Black gold has a well-established market waiting for the product to be pumped from the earth. And with gold, there are no real jobs created, and there is no economic stimulus. With black gold, we generate numerous jobs, and we stimulate the economy. In summary, gold looks pretty in jewelry, but has no possibility of producing income. Any chance of profits from hoarding gold is purely speculative, and if there are any gains, they will be heavily taxed. Crude oil is consumable with worldwide demand and an ever-diminishing supply. An expertly managed well portfolio will typically achieve 3 or more times return on investment throughout its life. If we can help you enjoy the rewards of investing in black gold, what would prevent you from going ahead right away? If we can help you enjoy the rewards of investing in black gold, what would prevent you from going ahead right away?